Meta's ad business grew 28% on real AI wins, but operating margin cratered from 43 to 31% as spending grew twice as fast as revenue. We are doing this video in two parts. First, I'll grade the report, then walk you through how I'd trade it. This is Meta Platforms, ticker META for Q2 2026. This is not financial advice. Everything in this video is just my own opinion for educational purposes only. Trading involves risk, and your results may vary. So revenue came in at $60.8 billion, only about 1% above the estimate. But the real story is the year-over-year number, up 28%, which is a monster growth rate for a company this size. And then on the EPS line, this is where it gets ugly. EPS actually missed by about 14%, which is a serious swing on a name that basically never misses. So on the beat itself, this earns a D. A revenue print barely over the line paired with an EPS miss of almost 14% is just not a beat. It's a mixed print with the bottom line going the wrong way. But on consistency, this earns an A, because Meta has been one of the most reliable beaters in mega cap tech for years, and one messy quarter doesn't erase that track record. The top line is genuinely impressive. 28% revenue growth to $60.8 billion at Meta's scale is elite, and Zuckerberg is claiming they're now the fastest growing ad business among reporting companies. And the reason it's growing that fast is the AI is actually working. Their new recommender model drove a 15.7% lift in conversions and an 8.3% lift in clicks on Facebook. Advertisers are seeing real results. On top of that, engagement keeps climbing. Instagram hit 2 billion daily users. Threads crossed 500 million monthly, and time spent on Instagram is up double digits, year over year. And here's a new one to watch. Family of apps. Other revenue, which is basically WhatsApp paid messaging and subscriptions, crossed $1 billion in a quarter for the first time, up 73%. That's a brand new revenue line that isn't ads. And they've got the balance sheet to fund all of this. Over $90 billion in cash, a new joint venture with BlackRock for a 1 gigawatt data center in El Paso, and $25 billion in fresh long-term debt raised. But even with all that, on profitability, this earns a D, because operating margin collapsed from 43% all the way down to 31%. The revenue is there, but the spending is growing almost twice as fast. Start with the profit side. Operating income actually declined 8% year over year, and operating margin fell from 43% all the way down to 31%. Even if you strip out the legal charges and severance, core operating income only grew 9% while revenue grew 28%. That gap is real margin compression. Then free cash flow. This is the number that stopped me cold. It collapsed 91% to $784 million from $8.5 billion a year ago, because CapEx nearly doubled to $31 billion in a single quarter. And that spending isn't slowing down. They raised the full-year CapEx floor to a range of $130 to $145 billion, and the CFO said they're maximizing 2026 and 2027 capacity with more foundational spending after that. On top of that, they raised the operating expense guide, raised the tax rate guide, and R&D alone grew 67% year over year to $21.7 billion. Every expense line is moving the wrong way. And finally, the CFO flagged twice that upcoming youth-related trials this year may result in a material loss. That's on top of the $2.4 billion legal charge they already took this quarter. There's more legal pain likely coming. So on guidance, this earns a D. They raised the CapEx floor, raised OpEx, raised the tax rate, and flat out refused to give a 2027 number when Morgan Stanley asked. Every knob got tightened the wrong way. And on red flags, this also earns a D. A 91% free cash flow collapse, a material legal loss warning, and a payback window push past 2028 all in one print is genuinely concerning. Putting it all together, this print is really a tale of two companies stapled together, a top-line ad business firing on all AI cylinders, and a capital consumption machine spending twice as fast as it's growing. Meta has now quietly transitioned from an ad business that does AI into an AI infrastructure company that happens to sell ads, and the CFO refusing to give 2027 CapEx tells you the spending curve is going higher, not lower. Overall, I'm giving this print a D+. Real quick before we get into the report, if you're getting value out of these review videos, do me a favor and hit that like button and subscribe to the channel. It's completely free, it takes 1 second, and it's genuinely the biggest thing that helps this channel keep growing. Alright, let's get into it. So that's my grade on the report. Now let's talk about what you actually do with it. I've broken this into 6 scenarios depending on where you stand. Whether you're looking to get in, selling cash secured puts, holding shares, sitting on covered calls, holding leaps, or underwater, or thinking about adding, find the one that best fits your situation. Okay, let's get into it. I'm not chasing this rally. The ad business is strong, but the massive spending overhang keeps creating these sharp sell-offs, and I'd rather buy into one of those. My plan is to scale into cash secured puts about 10 to 15% below where the stock trades now. Picking strikes I'd be genuinely happy owning through the 2027 spending cycle. The September 23rd Connect conference could pop the stock or crush it, so I'm not front-running it. I'd rather react than predict. For me, the play is waiting for CapEx-driven weakness before I make my move. My strike floor has to survive a worst case where spending guidance jumps to the top end and a youth lawsuit lands badly. That combo could drop shares 15 to 20%, so any strike within 10% of the current price feels exposed to me. My strike ceiling is tied to whether I actually want to own the shares long term, because taking assignment here means underwriting a 3 to 5 year infrastructure payback. I sell into post-earnings weakness when premium is fat, not into strength, and I stay in the 30 to 45 day window to capture decay before the next spending update. My rule here is selling CSPs well below current price. The ad business is doing exactly what I wanted, with 28% growth and AI helping conversions, but free cash flow collapsed and margins compressed. That tells me not to add up here. If my position got oversized on the rally, I'd trim 10 to 20% above pre-earnings levels and park the proceeds in cash to fund cash-secured puts at lower strikes. The September 23rd Connect event is the next real catalyst. New glasses and agent product reveals could pop it short-term, but follow-through depends on whether management can put real numbers on enterprise revenue. My stance is hold, but don't add here. If I've got calls that are deep in the money, I'm letting them get assigned instead of rolling. The tape stays choppy through 2027, and I'd rather buy shares back cheaper after the next spending-driven sell-off than pay up to roll strikes higher. For my at-the-money or slightly out-of-the-money calls, I stick to 30 to 45 day rolls instead of stretching out to 60 or 90, because implied volatility keeps expanding into every earnings print and spending update. I'm avoiding any calls that expire right after the September 23rd Connect event. Either I write short and close before it, or I go further out to survive a possible post-event pop. For me, the move is letting deep in the money calls get assigned. The original idea that AI optionality came free is just wrong now. Management explicitly told us $130 to $145 billion of annual spending with payback, pushed to 2028 and beyond. If I bought Leaps on the compounding ad business thesis, that's still intact. But the entry price now includes a huge infrastructure bet that plays out over 3 to 5 years, not the 12 to 24 month window my Leaps actually cover. I'd take partial profits on Leaps that ran up and roll proceeds into shorter dated calls tied to Connect, or into stock plus cash secured puts lower. My call is trim Leaps. Payback is beyond expiry. If I'm underwater, averaging down only makes sense if I'm willing to stretch my holding period out to match the 3 to 5 year infrastructure payback management laid out. If my original thesis was 12 to 24 months, this print didn't save it, and cutting the loss to put money somewhere else is a totally defensible call. If I'm adding with a longer horizon, my ad level prices in a full spending guidance raise to $150 billion, plus a $5 to $10 billion legal loss, which likely means shares 15 to 20% lower. For me, the rule is only add 15 to 20% lower. Bottom line, this print earns a D+ from me. The ad business is genuinely strong, but the free cash flow collapse and the CapEx trajectory changed the risk profile of this name in 1 quarter, and that's what my game plan going forward has to reflect. Thanks for watching.